In this webinar, I plan to underscore the latest risks to the global and the US economy in the wake of protracted European debt crisis. Number 1. The S&P 500 rally in the past 1 month or so was triggered by the Federal Reserve's plan to keep the interest rates low through at least 2014 and better than projected earnings of a large number of stocks of S&P 500 companies. Ironically, the US dollar is impacted both by the interest rates and psychological factors. In an environment of uncertainty, the USD being a safe haven currency would gain strength, notwithstanding cutting of interest rates. This is a big advantage to the Fed in having the ability to keep interest rates low for a long time. However, there is no free lunch, and in the long run, this is bound to create an environment of hyperinflation. Number 2. Keeping interest rates low gives an incentive to the government to borrow more debt, and when the inflation picks up in future, this will further help the government to pay off its huge debt with cheaper dollars. Number 3. Let me discuss a bit about how practical is the idea of keeping the interest rates low for a long time. In the short run, low interest rates might trigger some consumer demand, which constitutes 70% of the US real GDP. In the long run, however, the impact will fizzle out as too much growth of money will inflate the economy. The low rates have not been helpful to ignite the stagnant housing and job markets of the US. This is on account of multitude of rigidities prevailing in the US and job markets of the world. Number 4. Consumer confidence in the US declined recently. The key factor is stagnation in the most vital economic indicators, notably the real estate market in the US. More importantly, the European and Greek debt crisis is having a profound impact on the growth of the US economy, both in terms of sagging exports and nervousness in the capital markets. My humble assessment is that the markets will stay quite volatile in 2012 and beyond unless Europe finds a viable and sustainable solution to the Greek debt problem.